Evolution of cryptocurrency. Hello lovely YouTube family, welcome back to Evolution of. Cryptocurrencies are also known as virtual currency, are digital currencies developed and utilized by private entities or organizations. Since most cryptocurrencies aren't supervised by governments, they are referred to as alternate currencies, means of financial trades that are beyond the scope of government monetary policy. In today's video, we're going to talk about the evolution of cryptocurrency. Before we start, I want you to hit that red subscribe button so you never miss out on any of our videos. Bitcoin is the most well-known cryptocurrency and the first to be widely used. However, there are hundreds of cryptocurrencies and new ones to emerge every month. To separate themselves from Bitcoin, non-Bitcoin cryptocurrencies are referred to as altcoins. What is cryptocurrency? Cryptocurrencies defend their units of exchange with cryptographic protocols, which are highly complex code schemes that encrypt confidential data transfers. Cryptocurrency engineers create these protocols using sophisticated mathematics and computational engineering concepts, making it almost difficult to hack them and thereby replicate or counterfeit the safe currencies. These protocols often hide the identity of cryptocurrency users, rendering it impossible to attribute transfers and fund flows to real individuals or organizations. More on the fundamental of cryptography can be found in this Benzinga Money post. Decentralized control. Decentralized governance is another function of cryptocurrencies. The availability and value of cryptocurrencies are determined by the behavior of their users and their increasingly technical protocols embedded in their governing codes, not by the deliberate decisions of central banks or other regulatory bodies. Miners, cryptocurrency users who use massive quantities of processing power to lock transactions in exchange for newly generated cryptocurrency units and transaction fees charged by other users, are particularly important to the currency's security and smooth operation. Exchange with fiat currencies. Importantly, cryptocurrencies can be exchanged for fiat currencies on specialized online exchange markets, implying that each has fluctuating exchange rate with major world currencies, such as the US dollar, British pound, European euro, and Japanese yen. Cryptocurrency exchanges are prone to malware and are the most common target for hackers and cyber criminals looking to steal digital currency. Finite supply. The majority, though not all, cryptocurrencies have a finite supply. Their source codes have instructions that specify the exact number of units that can and may occur. Miners will find it more difficult to generate cryptocurrency units as time goes on, until the upper limit is reached and new money is no longer minted. Cryptocurrencies are potentially deflationary due to their finite production, making them more akin to gold and other precious metals, which have limitless reserves, than fiat currencies, when central banks would theoretically generate infinite amounts of. How cryptocurrencies work. The source codes and technical controls that support and secure cryptocurrencies are extremely difficult to understand. Ordinary citizens, on the other hand, are more than capable of grasping the fundamental principles and being knowledgeable cryptocurrency consumers. Most cryptocurrencies are functionally variants of Bitcoin, the first commonly utilized cryptocurrency. Cryptocurrencies, like standard currencies, convey meaning in units. For example, you might say I have 2.5 Bitcoin, just like you would say I have $2.50. The worth, stability, and legitimacy of cryptocurrencies are governed by several principles. Blockchain technology. The blockchain, also known as blockchain, of a cryptocurrency is the master public ledger that tracks and preserves all previous transactions in operation, validating possession of all units of the currency at any given time. A blockchain has finite length, having a finite number of transactions that grows over time as a database of cryptocurrency's entire transaction history to date. Any node of the cryptocurrency's computing network, the network of autonomous server farms operated by computer-savvy individuals or groups of individuals known as miners who continuously record and authenticate cryptocurrency transactions, stores identical copies of the blockchain. A cryptocurrency transaction isn't actually complete before it's connected to the blockchain, which happens in seconds. The transaction is normally permanent until it is completed. Most cryptocurrencies, unlike standard payment providers such as PayPal and credit cards, lack built-in rebate or chargeback functions, though some newer cryptocurrencies may include rudimentary refund features. The units aren't available for use by any group during the interval between the transaction's start and completion. Instead, they're kept in kind of an escrow, or, to put it another way, limbo. Double spending, or the modification of cryptocurrency code to enable the same currency units to be duplicated and distributed to different recipients, is thus prevented by the blockchain. Private keys. Per cryptocurrency owner has a private key that verifies the identification and enables them to trade units. Users may either generate their own private keys, which are whole numbers between 1 and 78 digits long, or use a random number generator to do so. They can acquire and invest cryptocurrencies until they have a key. The investor is unable to invest or convert their cryptocurrencies without the key, leaving their shares useless before the key is retrieved. Although this is an important security feature that helps to prevent fraud and illegal use, it is still very strict. Losing your private key is the equivalent to tossing a wad of cash into a garbage incinerator in terms of digital assets. You can generate a new private key and start accumulating cryptocurrencies again, but you won't be able to restore the cryptocurrency held in your old missing key. As a result, savvy cryptocurrency users are manically defensive of their private keys, keeping them in various digital, though usually not internet connected, and analog, i.e. paper, places. Cryptocurrency wallets. Users of the currency have wallets that contain unique identification that identifies them as the provisional owners of their devices. Wallets reduce the possibility of fraud for units that aren't being used, while private keys validate the validity of cryptocurrency purchases. Cryptocurrency trading wallets are very vulnerable to hacking. For example, Mt. Gox, a Bitcoin exchange based in Japan, shut down and declared bankruptcy a few years ago after hackers deliberately robbed more than $450 million in Bitcoin traded on its servers. Miners. Miners are the record keepers and partial arbiters of the worth of cryptocurrency societies. Miners employ extremely scientific approaches to validate the completeness, consistency, and security of currency's blockchains by using massive quantities of computing power, which is mostly embodied in private server farms operated by mining collectives consisting of thousands of individuals. The procedure is similar in complexity to the quest for new prime numbers and often necessitates massive quantities of computational power. Miners' work generates new blockchain copies on a regular basis, inserting fresh, previously unverified transactions that have not been included in any prior blockchain copy, effectively completing such transaction. Any addition is referred to as a block. Both transactions that have occurred after last new copy of the blockchain has been generated are included in blocks. Cryptocurrency evolved out of necessity. Digital currencies appear to ignore the doomsday predictions almost 10 years since the launch of Bitcoin, the first and most well-known blockchain. Despite the fact that cryptos have only been for around a decade, they have already have the ability to replace existing fiat currencies and transform the financial service industry. But how did they get that far in such a short time? The emergence of alternate cryptocurrencies. Users started to note some of Bitcoin's flaws when the currency rose in prominence and adoption. As a result, alternate cryptocurrencies, also known as altcoins, were created to address issues including anonymity, transaction speed, DNS resolution, and proof of stake, among others. Similarly, forks such as Bitcoin Classic and Bitcoin Cash were developed by modifying the Bitcoin code to shorten validation times, lower transaction costs, or address scalability concerns. The first altcoins to debut in 2011 were Namecoin, Litecoin, and Swiftcoin. Ethereum, Ripple, Zcash, Litecoin, Monero, and Dash are some of the most common alternative cryptocurrencies today. There are reportedly over 1,500 cryptocurrencies available on the internet. The initial coin offering ICO, a tool for developers to raise funds, has made it simpler than ever to introduce new cryptocurrencies. Mastercoin conducted the first initial coin offering ICO in 2013. Several cryptocurrencies have followed suit since then. Ethereum and NEO are two of the most well-known cryptocurrencies produced this way. Growing acceptance and surge into mainstream. Crypto is becoming increasingly common. Countries such as China, Ecuador, Tunisia, Venezuela, Singapore, Sweden, Estonia, Singapore, and others either developed or intend to launch their own national cryptocurrency. Furthermore, Bitcoin and other common digital currencies seem to be gaining traction, with an increasing number of merchants and providers accepting them as payment. Bullish sentiments continue to climb. The market cap of digital currencies is projected to hit $1 trillion this year. Benefits and drawbacks. Cryptocurrency consumers reap advantages not available to users of conventional fiat currencies, such as the US dollar, and the financial structures that those currencies sustain due to their political freedom and virtually impenetrable data protection. For example, although a country can easily freeze or even seize assets stored in a bank account situated within its territory, doing so with cryptocurrency funds, even though the issuer is a person or legal resident, is extremely challenging. Cryptocurrencies, on the other hand, come with a slew of risk and pitfalls, including liquidity and value fluctuations. They aren't present in several fiat currencies. Furthermore, since cryptocurrencies are often used to promote gray and dark market transfers, many countries are often wary of them, if not overly hostile. While some promoters tout cryptocurrencies as potentially profitable alternate assets, few, if any, serious financial practitioners regard them as little other than utter speculation. That's all for today. I hope you liked the video. If you did, make sure to hit that like button and subscribe to our channel so that you never miss any of our amazing videos in the future.